is Sunday Michael Ogun. I write for Daily Trust newspaper. Mr. Governor, following your acknowledgement of what had happened in the United States with the SVB and the impact in Switzerland, I was wondering, when you said the committee had evaluated and confident it would not have impact on our system, but I would like you to please expatiate on the level of the exposure of Nigerian financial system, especially startup, to the SVB collapse. Thank you.
We tasked our banking supervision department to ask for the bond portfolios, which is the main area of investment of banks, in order to earn some relatively high yield. And the reports that came back to us is that there is no direct investment by Nigerian banks in SVB that could result in a loss of investment there. That's on one part. But on the second part, we began to say, how are we sure that the Nigerian banking system is reasonably insulated to ensure that what happened in the United States does not happen in Nigeria? So we reviewed the various prudential guidelines were put in place. Nigeria, like I said in my discussion when I went to Joburg, Nigeria, being one of the countries, is one of the countries, or few countries in the world, where we have cash reserve deposit requirement. What is cash deposit requirement? It has been there even before I started banking, that when you deposit your money in a bank, a certain percentage of that deposit is held or serialized at the Central Bank of Nigeria to ensure that when there are kind of liquidity crises, that money is available to that bank for them to use to solve that liquidity problem, so that depositors don't lose their money. 2, we also have liquidity ratio, which is an indices of specified liquid assets against total deposits of banks, either held in cash in bank vaults, or bank balances, or money at call, treasury bills, OMO bills, and different other liquid instruments. And in Nigeria, our ratio is minimum of 30%. Banks keep above that. Today, liquidity ratio is almost about 43%. Cash reserve, we all know, just like we read, is about 32.5%. The loan deposit ratio, which means that banks are not over trading, is just about 52.47%. But we are happy that in spite of maintaining these prudentials, that the banks still remain profitable. The ROIs, the return on equities or return on profitability ratios have remained, I would say, relatively strong, even though when banks convert those profitability from naira to dollar, they seem weaker, but at the same time, the Nigerian banks have continued to make profit and they have continued to pay good dividend to their shareholders. So, in sum, we will say that the Central Bank of Nigeria has guidelines, prudential regulations or guidelines that have insulated the Nigerian banking industry from this kind of risk that we see, or contagion that we see or we saw last week in the United States. Nigeria, again, is one of those countries in the world where even after a bank has declared profit and paid taxes, a certain percentage of its profit must be set aside in order to build retained earnings and capital. If you're a small bank, it's going to be 25%, 1/4 of whatever profit you made is set aside and built into what we call the statutory reserve fund in order to improve the capital of that bank. If you're a big bank, then it is reduced to 15% of your profit after tax that is held back to build your retained earnings and your statutory reserve fund, and towards ensuring that your capital adequacy ratio remains strong. So I believe we've done well. Most banks are unhappy when this issue of cash reserve ratio comes up, or they tell their customers the central bank has done and done that. But I think at this time, people should now come to realization that there is good reason for putting this in place. And today is a day of reckoning where we are looking at that and say, thank God we have these prudential guidelines that have helped to insulate Nigerian banks from the kind of contagion that we've seen in the United States and Switzerland since last week.